All right, welcome. So you're thinking about jumping into your first real estate investment. It's super exciting, right? But then you get to the financing part and it can feel, well, a little overwhelming. Today, we're going to clear all that up. We're going to demystify this whole process and turn that confusion into some real confidence. Okay, so let's get right into it. The loan you pick, it's way more than just a boring financial detail. This is a huge strategic decision. I mean, it literally sets the stage for your entire investment, from how fast you can pounce on a deal to how you actually make your money. So here's what we've got on tap today. First, we'll look at the two big paths you can take. Then we'll talk about the specific loans for each strategy, bridge loans and DSCR loans. After that, we'll get you prepped to the pre-approval checklist, show you how experience pays off in a big way, and finally, cover that very first step you can take. Sound good? Let's do it. All right, section 1, the starting line. Every single investor's journey starts right here with one big choice. Are you in this for a quick profit? You know, the fix and flip. Or are you looking to build wealth over time by buying and holding for rental income? Okay, let's talk about that first path, the speed strategy. This one is all about getting in, adding value, and getting out fast. And to do that, you need a very specific kind of financing that's built for, well, speed. So what exactly is a bridge loan? Well, it's pretty much what it sounds like. It's a financial bridge that gets you from point A to point B. It's short-term, usually 12 to 18 months, and it covers not just the purchase price, but, and this is key, the renovation costs too. This gives you all the cash and the time you need to fix up the property before you exit, either by selling it for a nice profit or by refinancing into a more permanent long-term loan. And let me tell you, in a hot market, this speed is your secret weapon. I mean, think about it. Closing in as little as 24 to 48 hours, that means you can compete head-to-head with all cash buyers. You can swoop in and grab deals that other investors, the ones stuck waiting for slow traditional banks, don't even have a shot at. Okay, let's shift gears and look at our second path. This is the cash flow strategy. We're not talking about a quick flip here. No, this is all about building a portfolio of properties that put steady, reliable cash in your pocket, month after month. So here's the thing with a DSCR loan, and this is absolutely crucial. The property qualifies for the loan, not you personally. The lender is looking at the property's ability to generate rental income, not your personal pay stubs or your W-2s. For entrepreneurs, gig workers, self-employed folks, this is a total game changer. And this is the simple math behind it all. DSCR stands for Debt Service Coverage Ratio. You just take the monthly rent and divide it by the total monthly payment. And that payment, what we call PITIA, includes everything: the principal, interest, taxes, insurance, and any pesky HOA dues. If that number is over 1.0, hey, the property is making money. But of course, lenders want a little bit of a safety cushion, so they're usually looking for a ratio of 1.2 or even higher. You know, seeing them side by side like this really makes it click. A bridge loan for a fix and flip, that's a short-term sprint. The lender cares about the ARV, the after-repair value. What's this thing going to be worth when you're done with it? But a DSCR loan, that's a long-term marathon. It's all about the property's cash flow right now. So the real question for you is, which race are you trying to win? Okay, so you get the two main paths. Now let's get you ready for the journey. What do you actually need to have in hand to get pre-approved? Let's make a checklist. And here's some good news right off the bat. The barrier to entry might be lower than you think. For a fix and flip loan, you can often get in the door with a FICO score as low as 650. Now, obviously, a higher score is always better and will get you better rates, but 650 is a great starting point. Now, for those long-term rental loans, your FICO score has a direct impact on your leverage. That's the loan to value, or LTV. Basically, it's how much the lender is willing to finance. Just look at this. Once you get that score over 700, you can unlock up to 80% financing. That's huge. It means you only need to come up with the 20% down payment, which frees up so much of your cash for the next deal. Hey, remember when I said with DSCR loans the property does the talking? Well, this is exactly what I meant. No digging through file cabinets for old W-2s, no sending over personal tax returns, no pay stubs, none of it. The lender is just focused on the asset. Plus, you can borrow through an LLC, which gives you a great layer of legal protection. It's awesome. All right, this next part is so important. In the world of real estate investing, your track record, it's like currency. The more deals you successfully complete, the less risky you look to lenders. And guess what? They reward you for it with much, much better loan terms.
So let's say you're a brand new investor, 0 to 2 flips under your belt. These are pretty standard terms. You can get 80% of the purchase price, plus, and this is great, 100% of the renovation costs financed.
Okay, now watch what happens. After just a few successful flips, say 3 to 5, things start to get a lot better. Your leverage jumps to 90% of the purchase price, and your interest rate starts to tick down. That's a massive deal, because it means you're putting less of your own money into each project.
And here it is, the top tier. Once you're a seasoned pro with 10 or more flips, you're in the big leagues. Lenders will be fighting to give you up to 95% of the purchase price, and you'll get the absolute best rates available. This is how you really maximize your profit on every single project.
I love this quote because it really sums it all up. Finding the right lending partner, one who gets your strategy and is willing to grow with you, it's not just about getting one loan. It's about building a relationship that can help you scale your business like wildfire. Okay, you've got the knowledge, you've got the roadmap. So what's next? What's the one thing you can do right now to take that first step? Look, the best modern lenders have made this stuff so simple. It's really just 3 steps. 1, submit your deal. You can apply in just a few minutes, no crazy paperwork. 2, lock in your terms. You get clear, upfront numbers you can actually rely on. And 3, execute. You close with confidence knowing you've got a team supporting you the whole way. So, it all comes down to this. You've seen the 2 paths. Which one are you going to take first? Are you the flipper, creating value and moving fast? Or are you the buy and hold investor, building a long-term cash flowing machine? Really think about your personal goals and which strategy is going to get you there.